Hello there, and welcome back to Imaginr. Today we're going to talk about credit cards, one of the simplest, yet most ubiquitous financial tools in the modern world. You probably use one every day, but behind that small piece of plastic sits a massive industry built on fees, rewards points, interest payments, and you gotta wonder, how does it all really work? How do these credit cards actually make money? Well, today we're going to take a closer look at how credit cards became one of the most profitable machines in modern finance. If you look inside your wallet right now, chances are there's at least one credit card sitting there. Most of us, we use it every day, we buy groceries, pay for gas, ordering food online, or you book a flight. That little piece of plastic has become one of the most common tools that you use on a daily basis. And what makes this very interesting is the fact that the credit card system feels almost entirely invisible. If you want to go buy something, you just tap your card, wait a little second, wait for that beep, and then the transaction is done. But behind that one simple tap is a very complex system. Banks, payment networks, merchants, financial infrastructure, internet connections, all of that works together in the background to make that one simple transaction happen in just a few seconds. And while this feels like a very modern, common thing, this system did not appear overnight, obviously. It's taken decades for credit cards to evolve into one of the most efficient financial tools ever built. They allow people to borrow money instantly, move funds across the world, and make those purchases without ever carrying cash. Cash is annoying. It's inconvenient, takes up physical room, can get damaged, can get lost, and while a credit card has some of those issues, it is a far more convenient method of spending money. But convenience is not the only reason that this system exists. Credit cards generate enormous amounts of money for the companies involved. Every time that you swipe that card, there are financial institutions that are taking a small cut of that transaction. And of course, this all assumes that you are using the credit card correctly and not overspending, not missing late payments, because there are interest payments, late fees, and other subtle ways that you are charged money. This is still the introduction. I know this is still quite broad, but I want everyone to understand how this machine works, to get a baseline of what credit cards have done to our modern world for good and for bad. Let's specifically look now at the key players involved every time a credit card transaction happens. Whenever you make a purchase with credit, let's say at the store, the grocery store, whatever, it feels like a very simple exchange, but there are actually 4 different players involved in that purchase. The first is the cardholder. That's obviously you, the person making the purchase with the card. The second is the merchant. This could be anything from coffee shop that you bought coffee with your credit card, to a massive online retailer, Amazon, whatever. Merchants accept credit cards because customers expect it. They want that convenience, and refusing card payments would likely mean losing a significant amount of business. The third player is the issuing bank. This is the bank that provided the credit card to the customer. Think Wells Fargo, Bank of America, Capital One. When you swipe your card from your bank, it's your issuing bank that temporarily covers the cost of the purchase. Someone has to pay for it, and you are effectively borrowing money for a short period of time. The fourth and final player is the payment network. Companies like Visa, MasterCard, they operate the massive digital infrastructure that allows credit card payments to move between banks and merchants. You can think of these payment networks as the highways of the credit card system. They don't usually lend the money themselves, but they operate the networks that allow money and information to travel between these banks. But let's see how this really works. Let's zoom in a bit on the few seconds that happen during the transaction itself. When you swipe your credit card, when you tap it with that chip, there are a lot of things happening pretty much instantly. Firstly, the payment terminal at the store, when you tap your card at that little machine, when you put your card in the system, that sends the transaction information to the merchant's bank. When you go to the coffee shop and you tap your card, the merchant has its own bank and you're sending information to that bank. This bank is known as the acquiring bank, and its job is to process card payments on behalf of the merchant. From there, the acquiring bank forwards the transaction through the credit card network, usually Visa or MasterCard, which then routes the request to the issuing bank that provided your credit card. So there's 2 different things here. There's the bank that you have with your card, let's say Wells Fargo, and then let's say the coffee shop that you're purchasing at, they have their own bank. That is the acquiring bank. When you tap your card, the acquiring bank forwards that transaction through the network back to you, back to your issuing bank. It sounds complicated. It's basically just point A talking to point B through a network like Visa or MasterCard. At this point, your issuing bank checks a few things. It verifies that your card is valid, that it's, not expired. It confirms that the account is not flagged for fraud, and it checks whether you have enough available credit to complete the purchase. Have you maxed out your credit card? Do you have enough credit to spend during this transaction? Things like that. And again, all of this just happens in a few seconds. And if everything looks good, the issuing bank sends back an approval message through the network, which eventually reaches the merchant's payment terminal. And that's the moment you all know when the little green check mark shows up, it says approved on the terminal, and the transaction is completed. From the customer's perspective, the entire process feels effortless. You don't know that any of this is going on. This is all happening behind the scenes. You're just waiting for the approval message to show up. But behind the scenes, a lot of things are happening. Multiple financial institutions are communicating across networks, verifying your data, and authorizing effectively a loan in real time. Because that's what a credit card purchase really is. I mean, it's just a tiny loan issued at the exact moment you buy something. Even if it's just like a $5 muffin at a coffee shop, that is a loan in the sense that you are borrowing money, you have to pay it back eventually, and if you miss the payment, you're going to get charged interest. That is the foundation of the entire system of credit. Up until this point, the credit card system sounds mostly like a convenience tool. Oh, it's so amazing that you don't have to use cash. How convenient, right? Customers get to buy things and it's paid instantly to the merchant. It's all great, right? But behind every transaction, of course, is a small cost that most consumers never see. Every time that you pay with your credit card, the merchant has to pay a fee to process that payment. The fee is known as the interchange fee, and it's usually somewhere between 1% and 3% of the transaction value. And that might not sound like a lot at first, but when you multiply that across millions of transactions, the numbers really start to become enormous, especially for the people charging the fees. Imagine a restaurant processes $10,000 worth of credit card payments in a day, maybe a really, really busy Italian restaurant or something. If the average interchange fee is around 2%, let's say it's halfway in the middle, that means that about $200 of that revenue immediately goes to the financial institutions processing those payments. And for a small business that operates on pretty thin profit margins, that can be significant. But even so, despite the fees, most merchants are still going to accept credit cards because that's just what customers expect. It would be very, very difficult to just refuse credit outright for many businesses. There's too much potential money to be made from credit to treat the fee as a significant roadblock. So this means that merchants effectively participate in the credit card ecosystem because the convenience drives consumer behavior. And for the banks and payment networks, those tiny percentages collected from millions or billions of transactions become one of the most reliable revenue streams in modern finance. These cards are used all the time, every day, millions and millions of times. That is generating an enormous amount of revenue simply from the fees. What makes this system particularly powerful is the consistency of it. People are going to be buying groceries, gas, clothing, tickets to events all the time, every day. And every single time that happens, those purchases generate a small fee. From the bank's perspective, this generates a very steady stream of revenue that does not rely on customers carrying debt. I know many of us have this expectation, well, how could the credit card system work if consumer debt didn't exist? If everyone paid their card on time, everything would just collapse. And while that is definitely true, consumer debt is massive, it is not the only way that banks and credit card companies and whatnot make money. A lot of the time, they are making it from these fees. Even if someone pays off their balance every month and never pays interest, the bank is still going to earn money from them somehow. And obviously, the payment networks like Visa and MasterCard also benefit from this structure. They operate the infrastructure that routes transactions between the banks and the merchants, and they take their own small cut of the process. Together, these companies have effectively built the financial equivalent of a toll road. Every time that you go through that toll, every time that a credit card transaction travels through the network, a small fee is collected. And those fees are going to keep rolling through those tolls day in and day out. Think about how slowly this would all be if banks had to talk to each other directly, if there was no highway. They had to take the figurative back roads. That would be ridiculous. There are obviously fees and downsides and things that we don't like about this infrastructure, but without this infrastructure, credit card payments would be far slower and much more difficult to coordinate. And the power of these networks come from the scale. The more banks, the more merchants and customers that join that network, the more valuable the system becomes for everyone. You can use Visa at virtually every business in America. It's pretty hard to find a place that doesn't accept it, and that obviously comes with a lot of power. Its ubiquity gives it strength. The term that economists give this is a network effect. As the participation grows, the system becomes stronger and harder for competitors to replicate. How on earth could you possibly make a competitor to Visa nowadays when it's already so common? And this is why one of the reasons that the credit card industry has remained dominated by just a handful of major networks for decades. And obviously, as more of the world moves away from cash towards these digital payments, like credit cards and crypto, those networks become the backbone of modern commerce. It's going to be harder and harder to get away from something that is so foundational to our daily finances. We've already talked about convenience a little bit. That's why people like to carry credit cards and debit cards. But another factor is security. If someone loses their cash, their physical money, it's usually just gone forever. There's no way to get your $20 bill back if it falls in the river. But if a credit card is stolen or misplaced or even physically destroyed, it can often just be frozen or replaced quickly. You just go on your bank website and just deal with it. It's not that hard. There's also fraud protection systems that help detect suspicious transactions, which gives consumers an extra layer of safety. And businesses have played a major role in this transition. Digital payments are easier to track. It's easier to record digital payments for accounting. You can keep track of your finances pretty easily if it's done online. And it's just simply faster at the point of sale. When you buy something in person, it's usually quicker to use a card than to hand over cash, and you have to count the number of coins and how much change you're due, right? It's more complicated. For large retailers like Amazon or Walmart or Target or whatever, electronic payments are far easier to deal in terms of the logistical challenges of handling and transporting physical cash. And obviously governments and large-scale financial institutions have supported this shift wholeheartedly. It's a lot easier to be tracked, to create clear records, which can be good to reduce financial crime, but it obviously is a much easier way to track what you're doing. And a lot of people do not like that level of privacy that they have lost. And like it or not, paying with cash is inherently harder to track than digital. So all these factors are starting to coalesce into pushing the global economy towards a more cashless future. Now, as a whole, we've still talked quite broadly. We've talked about some of the fees, some of the key players, but now I want to get into some of the more nitty-gritty and, let's say, dark side of credit. Interest, paying back your balance, the major things that we associate negatively with credit cards. So again, the fees that I've discussed already, this is just part of the story. This is perhaps a part of the credit card system that is lesser known, but the more obvious part is interest. At its core, a credit card is not just a payment tool, it is a lending product. Every time that you use that credit card, the bank is giving you essentially a short-term loan. I've already discussed this, but the bank pays the merchant immediately and you repay the bank later. Very simple. For many people, that repayment of that balance happens at the end of the month. When that statement arrives, you pay off the whole balance like a nice, good citizen and you move on. But the credit card system is designed to allow something else as well. As I'm sure you can guess, it is not paying off the full balance. It is in the bank's interest for you to hold on to your balance, to merely pay the minimum monthly balance. And the rest of the balance that is not paid off is just carried forward into the next month. Not a big deal, right? No, it is a big deal. Because whenever that balance is carried over, every time that you're not paying that off, you are accruing interest on that. And while I understand that many people maybe can't pay off their debt fully, their bills are simply too high, they're working paycheck to paycheck and they have to carry a balance, it is not the case for everyone. And many people make foolish purchases that result in them holding a balance and therefore creating interest for themselves that they have to pay off. And the moment that a balance is carried forward, the transaction changes from a simple payment system into a lending system. The bank is no longer just processing a purchase, it is providing ongoing credit. And if you multiply that across the millions or billions, frankly, of customers, you start to see why credit cards are such an attractive business for banks. They are hoping that you are financially foolish with your money, and they allow to lend money continuously in small amounts across a massive population of customers. And unlike traditional loans, like a car loan or a mortgage or something massive that requires quite a process to acquire, credit cards are used every day, repeatedly, day after day, purchase after purchase. It is an ongoing system where loans are constantly being generated. That cycle of spending and borrowing is what makes the system so powerful. Let's talk about interest a little bit. Once a credit card balance begins carrying over from month to month, interest enters the picture. Credit card interest rates are typically expressed as an APR, or annual percentage rate. In many cases, these rates are significantly higher than other types of loans. For example, with mortgages, a house loan. These might carry interest rates in the single digits, but even so, 7% on a house, that's pretty expensive. Car loans can be similar, but maybe a little bit higher. Credit cards, however, can easily reach 20+% or more. And again, think about that. If you have a balance of $1,000 of credit card debt and you don't pay it off for a whole year at 20%, you now owe $1,200. 20% of that loan has now accrued over that annual period. And that difference is obviously very, very important. When someone carries a balance on their card, interest is accumulating on the unpaid portion of the debt. If the balance remains unpaid for long enough, that amount owed can grow extremely quickly. Each revolving balance generates a steady stream of interest payments over time for the bank. And because credit cards are used so frequently, new balances are constantly being added to the system. There's always going to be someone that doesn't pay their balance on time and therefore creates interest for the bank. Some customers pay their balance off in full every single month and pride themselves on that. And you might think, oh wow, the bank is getting no money from me. Nope. The banks are still earning money from you anytime that you swipe your card and you generate those swipe fees for the bank. Let me take a moment to switch a little bit and talk about rewards programs. As I'm sure you're aware, many credit card programs, their thing is offering points back or cash back when you spend as a incentive to get you to spend on your credit card. And this feels great to consumers. It feels like a free benefit in a way. But from the bank's perspective, rewards programs are actually just a tool. And the goal is to encourage people to use their credit card more to generate more fees every time you swipe. The more transactions that flow through that card, the more fees that the bank collects. The higher spending also increases the likelihood that some users will carry balances, which of course will generate interest for the bank. In other words, rewards programs are simply designed to increase activity within the credit card ecosystem. They want you to use that card as much as possible. Think about it from the perspective of airline miles. Airlines will partner with credit card companies to offer loyalty points for spending. When customers use their card, they can accumulate miles that can be later redeemed for flights. But behind the scenes, banks are actually purchasing those miles from the airlines. This creates a partnership where both companies benefit. The airlines sell the miles for money, and the bank encourages more spending. When you spend on your card, you will generate more miles. The airline will then sell those miles to the bank, and this is basically one powerful feedback loop. You feel motivated to use your credit card, right? You want to earn those rewards, earn those points, those miles. Merchants are going to accept the payments from you. Banks will collect fees on those payments and interest if you carry a balance, and the entire system continues to grow. And so this leads to an interesting question. If rewards programs encourage people to spend more, how does using a credit card actually change consumer behavior? Well, this is kind of the crux of what credit is. I've mentioned it a little bit earlier, but I'm sure you know what a debit card is. It is essentially the inverse of a credit card where you are spending immediately. You are basically spending cash digitally with a card, and it is instant. There's no balance. You are handing over money for a product. But when it comes to credit, where you are borrowing money and you'll just pay it back later, right? It has been shown that people are much more likely to spend more money when they use credit cards compared to cash. It's just simple psychology. When you pay with cash, that experience feels painful. I just handed over a real bill, or even with a debit card, I just handed over my money. But with a credit card, that feeling is much weaker. You might think, well, I can just pay it back later. You know, it's not really my money per se, even though it is your responsibility to pay that back. But no, instead of physically giving up something, that transaction becomes very digital and abstract. It feels much easier to just little tap on the terminal, right? And because of that psychological distance, people often feel far less resistance when making purchases, especially online. It's so easy to just click a button, add to cart, have it show up on your doorstep. It's very seamless. And this is obviously a very attractive thing for banks and payment networks. They want people to feel that threshold come down, to feel like it's not that big of a deal to use credit cards. Now, when it comes to premium cards and fees, annual fees, not every card is the same. Some cards are completely free to use with no annual fee at all, while others, they might charge a yearly membership fee. Higher end credit cards often come with benefits like travel insurance, maybe an airport lounge access, concierge services at hotels. A very common annual fee card is the American Express card, where you can spend, I think, $95 a year, something like that, but in return, you can get cash back at grocery stores, and often quite a bit of cash back. A lot of the times, these annual fees can effectively pay for themselves if used correctly. If you go to a specific grocery store often enough and get enough cash back to cover the annual fee, then it starts to make sense. Or maybe you're a very frequent traveler. You fly once a week, spending several $100s a year on a card that has airport lounge access or other perks. That might make sense. Even if the customer never carries a balance, the bank will still be earning money from the membership fee. The premium cards often attract customers who just spend more money. If you can afford to spend $300 a year on a card, you probably have more money to spend, right? And finally, premium cards can help build long-term customer relationships. If you have that premium card that gives you cash back at the grocery store, and you become accustomed to earning that extra money through those points back, then you'll be more reluctant to switch to a competitor or cancel the card outright. Why would you stop using a card that is actually earning you a little bit of money every year if you're using it correctly, obviously you're going to keep it. And so in this way, annual fees and premium benefits help strengthen the overall profitability of the credit card ecosystem. Now, interest payments are one of the most visible ways that banks earn money from credit cards, but they are not the only way. Another major source of revenue comes from penalties. If you miss a credit card payment, if you miss a deadline, even by a single day, then some cards will charge you a late fee. Every bank is different, every card is different, but these penalties can often reach $25 or $30 or maybe even higher for repeated late payments. And for consumers, this is obviously very frustrating, to be spending $30 simply because you missed it by a day. But from the bank's perspective, they serve two purposes. Firstly, they encourage customers to make their payments on time, because while they would love to be earning interest from you and late fees, they still need the credit paid back, at least somewhat smoothly. Like, we can't have everyone not pay off their credit. It has to work to a certain extent. But secondly, the late fees generate, obviously, additional revenue when customers fail to meet those deadlines. I mean, that just makes sense, right? All of this reinforces the structure of the credit card system. Rewards encourage spending, interest generates revenue from borrowing, and penalties enforce the rules of the system. Let's talk about credit scores a little bit. Of course, lending money is always going to involve risk. Whenever a bank issues credit, whenever you use your credit card, there's a possibility that the borrower may not repay the debt. And credit card companies manage this risk by using a system that most consumers are already familiar with. It's your credit score. A credit score is essentially just an estimate of how reliable someone is at repaying money that's been borrowed in the past. It's based on multiple factors, like your history of payments, how long have you been paying money back, the amount of debt that someone is carrying at a given time, how frequently they apply for new credit, the variety of credit that you have, credit card loans, mortgage loans, car loans, right? And banks use these scores to decide whether someone qualifies for a credit card and what interest rate they should receive. Customers with strong credit histories usually receive lower interest rates and higher credit limits. They are seen as safe borrowers, and this is most useful when you are trying to get a mortgage on your home and you're trying to get a lower interest rate on your home. The better your credit score is, the more likely you will be to get a lower interest rate. Customers with low credit scores may still qualify for cards, but often at much higher interest rates. And in some cases, if your credit score is bad enough, they may be required to start with a secured credit card that requires a deposit. And this credit score system allows banks to lend money across a much wider range of customers while managing the potential losses. Higher risk borrowers may generate more interest revenue, but they also may carry a greater risk of defaulting on their loan. And that just means not paying the money back, basically. Lower risk borrowers may generate less interest, but they tend to repay their balances more reliably. By analyzing all this financial data, banks are attempting to balance these risks while trying to keep the credit card system profitable for themselves. So let's put all of these pieces together. The credit card system may initially have seemed like just a simple payment method, but now you can see that there is a lot going on behind the scenes. There are many different parts of the system. There are merchants who accept cards because customers expect them. There are payment networks that process those transactions and move money across the world between banks. There are the swipe fees that are generated every time you use your card. There are interest payments that are generated every time that you fail to pay off your balance. Annual fees, late fees. There's a lot. All of these mechanisms are reinforcing each other. They are essentially creating a whole system that operates continuously every single day. Billions of purchases are happening all the time, every day, every week, and each one of those moves across this network of banks, merchants, and payment processors. So again, from the outside, it seems pretty simple, but now you can see that there's a lot going on. There is a lot of infrastructure behind that one single swipe that you do at the grocery store. All of that is generating billions of dollars behind the scenes. So I hope you learned something useful. Hope you thought it was interesting, and I'll see you in the next one.